The Aterian stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side to wait for a better timing. As the market is still very volatile at the moment, we should always be mindful about which stocks to pick, as well as the exposure and the timing of the positions we have. Over the past few days, the price action of Aterian has brought the stock to $6.38 before stabilizing around $5.53. And the short-term trend of Aterian has been bullish because the market is now confirming its interest to keep the hope up for a short squeeze. And the recent price action tells us that it is now seeing a significant increase in the retail participation to bring the stock higher. When we look at the long-term price trend, Aterian has been bearish and ranging, with different periods of volatility in both up and downward dynamic. It's worth mentioning that Aterian is one of the more successful attempts so far for retail traders to recreate the same effect with AMC and GameStop to participate in a short squeeze, given that so many odds are currently pitted against them. The short interest is still one of the higher ones in the market for Aterian, and as long as the significant chunks of the short orders don't get redeemed, the big picture would remain likely the same. The thing is, the market is currently having a lot of selling pressure overall, not just from the people who want the short for the purpose of shorting. So it's not just the meme stock and the short squeeze candidates that may feel the heat. So this is why I think that what's happening to Aterian is both amazing and potentially fragile as well. Now, let's take a look at the technicals of the stock. The trading volume of Aterian has recently been 99 million shares compared to the average volume of 36 million shares. Over the previous 52-week period, its price fluctuated between $2.10 and $27.00. The market cap of Aterian is currently at $351 million versus the enterprise value of $208 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many companies as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called a goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, and a bigger online following. It is basically what makes this company unique compared to its competitors. In other words, it's not a tangible asset that companies can use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because the enterprise value can be less reactive than the market cap in volatile situations. If the company goes to liquidation, the goodwill would be gone, and the bondholders and the shareholders would be left sharing whatever that is left that is not impaired. And this is likely going to be far less than what we see on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 157% higher than the 1-month low, 163% higher than the 3-month low, and 163% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment of where the stock price is likely going to go next, the implied volatility is 217% versus a historical volatility of 175%. The put-call volume ratio is currently at 0.28. It is normal for many stocks to tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 239,000 contracts in a day, versus the 30-day average volume of 55,000. In terms of open interest, the most recent volume of open interest has been 285,000 contracts versus the 30-day average of 93,000 contracts. In terms of its shareholder structure, institutional shareholders own about 18% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It is relevant to understand the shareholder composition of a company because it helps us to determine if you should be holding the stock long-term or to view it simply as a trade opportunity. If the stock is mainly held by retail traders, it can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, a lot of exceptions would apply since many great titles are mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 35% of the total float and 55% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volumes coming out of the dark pools, this is a suggestion that there may be institutional positions taken to short the stock, and there would be potentials for a short squeeze. With all that being said, my suggestion about Aterian is to have an existing position in it and to be ready for the short squeeze potential within the next couple of months. If the stock retraces, I would suggest to commit more capital from that point onward, because the stock is currently making new highs in the medium term, and this is why I would recommend to go in slow, but to make sure that you have a foot in the door. My recommendation of the capital is between 1 to 3% of your portfolio. I would also recommend to split the allocation in batches of 20% at a time, so that you may purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.